So clearly it's not dying now. But look, I mean, look what you have behind you. You've got the white paper behind you. And even if you're someone who's involved in Bitcoin many years, do you really understand the white paper? Like it's complicated, right? So again, I want to be a little bit forgiving, of people generally. But I think you don't need to be able to get through the entire white paper to understand that this is definitely a massive macro structural change. And I call it a great invention for humanity.
For over a decade, critics have declared Bitcoin dead more than 400 times, yet here we are, witnessing its relentless resurgence. This cryptographic phoenix keeps rising from the ashes of regulatory crackdowns, market crashes, and media skepticism. But what makes Bitcoin so resilient? The answer lies in its radical simplicity, a decentralized ledger that solved the double spend problem without intermediaries, a breakthrough so profound it's reshaping global finance, even if most users never fully grasp Satoshi's technical white paper. Dan Tapiero, a macro investment veteran, puts it bluntly: you don't need to understand every line of code to recognize Bitcoin's seismic impact. While the white paper's math may baffle casual observers, the real-world implications are undeniable. A borderless, censorship-resistant asset challenging centralized monetary systems. Tapiero urges patience with skeptics, but his conclusion is clear. Bitcoin isn't just another tech trend. It's a great invention for humanity, one that's surviving its critics precisely because it solves problems no traditional system can. As institutional adoption grows and nation-states explore Bitcoin reserves, the obituaries look increasingly absurd. The real question isn't whether Bitcoin will die, it's whether legacy finance can adapt to a world where money flows without permission. Buckle up, the revolution is just getting started. We will now bring you more clips from Dan Tapiero's explosive interview to gain more insight. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
So I think at its very foundation, Bitcoin has always been about a hedge against debasement, whether it was of a specific currency or the debasement of savings over a longer period of time that's brought on by negative real interest rates, right? And so to get ourselves out of the 08-09 crisis, negative real rates were held for quite a long time. And in fact, if you were smart enough to have purchased Bitcoin at that time as a hedge, you've done pretty well. And I would say the same thing vis-a-vis gold. In fact, I sort of did have that similar idea and launched my physical gold business, GBI, right at the end of 08-09 because I was worried about debasement. I just wasn't smart enough to understand that the digital form was going to be worth, 100,000x of the physical form, physical gold, which has done a 4x since that company was founded. But, 4x is a dramatic under-improvement. So I would say that's always been embedded in the DNA of Bitcoin. I mean, I don't think we should talk about the past 15-year history. I would just say, bringing it up to today, I mean, Matt makes the right point that the deficit has gotten very large. And I think there is a view in the administration that they have to do whatever it is that they can right now to make sure that that deficit doesn't get larger. Unfortunately, I think when you decide to tighten many different levers of fiscal policy all at once, you need to do that with a monetary offset or a coordinated monetary offset. So you have Doge, which is actually getting rid of departments wholesale. You have fiscal tightening, i.e. reduction of spending by many of those departments. And now you have the whole tariff situation. And all of these, those three things are out there in a way to try to reduce the deficit. Now, fiscal tightening is of that nature hitting all at once will have a dramatic impact on growth. And so I think GDP this year and growth generally will be softer, potentially a lot softer. And that can be okay if there are monetary offsets. So if the dollar weakens, as we've seen, that's okay. If interest rates are cut or go down, that's also an offset. The problem we have today is that all this fiscal tightening is being attempted without those other offsets. I think if the dollar were to go down another 10%, as it has in the past few months, if it were to do it in the next few months, I think that would almost be a danger signal. And interest rates have been stubborn at these levels, and the Fed is not really looking forward and saying, okay, well, we're worried about GDP growth, even though they should be. We're worried more about an inflation problem that actually I don't really think will trump the growth, literally trump the growth problem. So we have a situation today where we have a policy mix that many investors think might not be sustainable, and therefore you have a move to gold. And I think also to a lesser degree, Bitcoin right now. But I think that the dollar going down 10% in such a short period of time is a reflection of foreign investors' concerns about our policy mix. Well, I mean, I would just say that it's a new asset, so it's not that the volatility is unwarranted. There's price discovery takes a while. And I just, many of the large, I would say, capital allocators or large investors, who would come to the space are not there yet. So it still feels, to me, it's still very retail oriented, despite the fact that BlackRock is there now, and Bitwise, and you have ETFs, and there are some ways for institutional investors to be involved. It's still dominated by individuals. And so individuals are not really professional investors. And so when a market gets mature, you have more professional investors, and they dull the volatility. We see all this crazy extremes and swings because people are panicking at the highs and they're, panicking at the lows, and retail exaggerates both those highs and lows. Bitcoin's volatility has dropped from 10 years ago, and I suspect over time it will drop. But from my perspective, the volatility is a healthy thing. You're not going to get the returns without the volatility. So I wouldn't say that you said before, oh well, volatility means is not equivalent to risk. I think it is. Maybe it's not equivalent to risk of going to zero, right? I think many of the alternative cryptocurrencies, some of the less relevant ones, they all go to zero. In my world, Bitcoin and then sort of Ethereum have achieved network effect, and now perhaps also Solana is moving in that direction. But all the other ones are venture projects, and they all do have the ability to go to zero. Not all of them, but many of them. And so the volatility that we see today in Bitcoin is a fraction of what it was 10 years ago, but we continue to see that volatility in some of the alternative smaller projects.
At its core, Bitcoin was born as a rebellion against financial debasement, whether from currency manipulation or the silent theft of savings through negative real interest rates. The 2008 crisis proved this thesis right. Those who recognized Bitcoin's potential early were rewarded handsomely, just as gold investors benefited from monetary easing. But while physical gold has delivered a respectable 4 times return since 2009, Bitcoin's 100,000 times surge highlights its unique advantage: digital scarcity in an age of runaway fiscal and monetary experimentation. Dan Tapiero draws a direct line between today's unsustainable policy mix and Bitcoin's resurgence. The deficit is out of control, he warns, pointing to simultaneous fiscal tightening, aggressive tariffs, and a lack of monetary offsets. The result? A dollar under siege, growth slowing faster than expected, and investors fleeing to hard assets like gold and, increasingly, Bitcoin. While the Fed remains fixated on inflation, Tapiero sees a more urgent threat: a growth crisis that could force abrupt policy reversals, turbocharging Bitcoin's role as a hedge. Yet Bitcoin's volatility remains a sticking point, a symptom of its retail-dominated market. But as Tapiero notes, this is the price of asymmetric upside. You're not going to get the returns without the volatility, he argues, emphasizing that Bitcoin's wild swings have dulled over time as institutional players enter. The key distinction? Unlike altcoins, which risk going to zero, Bitcoin's network effect makes it the only crypto asset with the durability to rival gold. In a world of fiscal recklessness and policy missteps, that may be the ultimate insurance policy. While Dan Tapiero's macro perspective reveals Bitcoin's unstoppable momentum against monetary debasement, Matt Hougan brings crucial institutional insights to complete the picture. He explains how Bitcoin's dip and rip dynamics and regulatory breakthroughs are creating the perfect storm for mainstream adoption. Let's watch more clips from the interview.
If you look at Bitcoin's historical response to macro volatility, it tends to fall in the short term and then tends to recover and go above in the long term, right? I call it dip and rip. And that's happened repeatedly, right? If you look at the average return of Bitcoin on a day, the S&P 500 is down 2%. It's minus 2.6%. But then if you pan out 3 or 6 months, it's dramatically outperformed the S&P. It's outperformed gold. It's outperformed everything else. And from my perspective, that actually makes actual mathematical sense. If you think about Bitcoin pre the start of tariff confusion, let's imagine it's a store of value asset and it's chasing a market that's worth $20 trillion, which means, it should be $1 million asset at some point in the future, let's say 10 years in the future. If you're valuing it today, you then use that addressable market and discount it back to its present value. And that's sort of what the market is mathematically doing. If you have an event that grows the long-term store of value asset, so it's now going after a $30 trillion market because the world made traditional fiat currencies less secure. So its value should be $1.5 million. That doesn't mean that the value today should go up if the discount factor also goes up because the market has been more volatile. And I think that's why you get this dip and rip. It's consistent, to my mind, with being a long-term store of value asset that's still emergent and therefore more volatile. You get the dip and rip perspective. It's actually what sort of classic academic finance would tell you would happen in these sorts of situations. It's just confusing for people because they have a hard time holding both of those ideas in their head. I was at the Barron's Top Teams Conference, which is some of the top advisors, financial advisors in the US. These are people with 1, 5, 10, $20 billion plus in assets under management. And I surveyed the room. I asked them how many of them could buy Bitcoin in an ETF wrapper or any other way for their clients. And less than half the room could still have access to it. So literally, this is not even institutions. This is not insurance companies. These are financial advisors. They're far down the spectrum. And most still to this day, at least half of the largest financial advisors in the US physically can't buy it on behalf of clients. That's how early it is. And it'll be years until they do, right? And now it's growing. More and more of them are. But it is extraordinary that it is still early, but it is still exceptionally early. I'm optimistic that it'll happen at an accelerating pace. Yeah. I'll just add one fun stat. We do a survey of institutional investors every year. We've done it for 7 years. And we ask them what's preventing them from allocating to Bitcoin and crypto. And a lot of people would assume it's volatility, or I don't know how to value it, or what's the cash flows, or isn't it criminal use? Actually, the number one answer for 7 straight years was regulatory concerns. And so I raise that because I do think over the last year and a half, we've knocked down 3 major barriers. We've knocked down access via the ETF. We've knocked down regulatory concerns via the change at the SEC. And we've started to knock down concerns about reputational risk. When you have Larry Fink out there talking about Bitcoin and you have Stan Druckenmiller talking about Bitcoin, the reputational risk come down. And I actually think those were 3 of the primary gating factors. There are others, but I really think we've overcome those 3. And I think that's going to let the water flow through a little bit faster than it has in the past. I mean, I think it speaks to Bitcoin's strength, how much it accomplished given the scale of forces arrayed against it over the past 4 years. And you mentioned SOB 121, literally said banks can't touch Bitcoin or they'll die. That's an absurd approach. The SEC sued every major entity operating in the crypto market and issued subpoenas to literally everyone, which cost untold billions of dollars in legal fees and distraction. You had a senator with a war on crypto. You had China, variously banning it. And yet, the asset went from whatever, 10,000 to 50,000 and made significant progress. I think that speaks to, today it's been completely reversed. It's now an extraordinary tailwind from all those perspectives. And I don't think the market has caught up to the long-term impact of that. But it really speaks to the strength of this asset, that it was able to stand up against the full force of the US federal government in all its aspects and still make progress. I think it's really remarkable.
Bitcoin has mastered the art of turning short-term chaos into long-term gains. When markets shudder, whether from Fed policy shocks, trade wars, or stock sell-offs, BTC often stumbles first before staging spectacular comebacks. The pattern is undeniable. On days when the S&P 500 drops 2%, Bitcoin typically falls 2.6%. But fast forward 3 to 6 months, and the digital asset consistently leaves traditional markets in the dust, outperforming stocks, gold, and bonds by wide margins. This phenomenon, what Matt Hougan calls the dip and rip effect, isn't random, it's mathematical inevitability. Bitcoin isn't just reacting to volatility, it's pricing in its future role as the world's premier store of value. Every crisis that erodes confidence in fiat currencies actually expands Bitcoin's long-term potential, potentially transforming it from a $1 trillion asset today to a $30 trillion mainstay of global finance. The short-term dips represent nothing more than temporary adjustments in discount rates, speed bumps before the next explosive rally. Despite the recent ETF breakthrough, Bitcoin remains remarkably underserved in traditional finance. At a recent Barron's conference for elite financial advisors, many managing $10 billion or more, Hougan discovered less than half could even purchase Bitcoin for their clients. For years, regulatory uncertainty created an artificial dam holding back institutional capital. But with the SEC's anti-crypto crusade ending and Wall Street titans like Larry Fink now embracing Bitcoin, the floodgates are finally cracking open. Bitcoin's most impressive feat isn't its returns, it's its resilience. Consider the forces that tried to kill it. China's outright bans, the SEC's barrage of lawsuits, Senator Warren's very public war on crypto, and banking CEOs declaring it worthless. Yet through it all, Bitcoin rallied from $10,000 to over $50,000. Now, with the regulatory tide turning, the market hasn't fully grasped what's coming. A generational shift as institutional money meets digital scarcity. The lesson is clear. Bitcoin's volatility isn't a weakness, but the price of admission for an asset rewriting the rules of money. Every panic-driven dip sets the stage for the next historic rip higher. And this time, with Wall Street finally joining the party, the next rally could be the most explosive yet. Thanks for watching. Please share this video, hit the like button, and don't forget to subscribe. See you in our next video.